everyone, this is Jay Harris, Chief Option Strategist for Tom Gentile. I have a strategy video for you. It's called Get Paid Whether You Sell or Not, Covered Call Strategy. Here's a typical situation. You own a stock. Now, obviously, we don't have the stock certificates anymore. It's all pretty much done electronically. But you own a stock, and whether it goes up or it goes down, eventually you're going to want to sell that stock. Obviously, if you sell it for a higher price in which you purchased, you make a profit. If you sell it for a lower price in which you purchased, you take a loss. But how would you like to get paid just for putting it up for sale? That's right, that stock that you own in your account, instead of just going directly to the markets and saying sell the stock, put a for sale sign up. Sell an option to somebody for them for the right to buy your stock at a later time at a certain price. You'll get paid for putting it up for sale and maybe even eventually get paid for selling the stock. But why not get paid a little bit extra just for putting it up for sale? This is what's known as selling the right to buy your stock. Specifically in this case, folks, you are selling anyone the right to buy your stock at a specific price, which is known as the strike price, on or before a specific date, which is the expiration date. Now, in the world of options, this type of a contract that you're selling is a call option contract. And because you're selling a call, you're selling somebody the right to buy the stock from you at a specific price on or before a specific date. You must own the stock. And because you own the stock, that means you are covered. Right means sell, writing means selling. So you're selling the right to the universe, anybody, the right to buy your stock that you own. Therefore, you are writing a covered call. Now, as an owner, you can't sell the stock while the contract is still open. When you sell that contract against your stock, that's an open agreement that they can buy the stock anytime before expiration at that specific price. Now, I'll talk about how you can, end that open agreement in just a few moments. But because they have the right to buy the stock on or before expiration at that specific price, you yourself can't go sell that to anyone else. The amount you sold the call option for is the premium. That's the money you're going to get paid for that call option contract. The buyer, they have the right to buy the stock from you at a specific price, anytime up to and including that expiration day. Whether they buy the stock from you or not, you are going to be able to keep that premium. So for options, one option contract is the right to buy or sell 100 shares of stock. Therefore, you have to own at least 100 shares of stock to be able to do this. If you have 123 shares of stock, you can sell one contract, only putting up 100 of those shares for sale. The other 23 shares of stocks won't take part in this covered call experience. Now, whatever the premium is, you multiply that by 100. So if you're selling one call option contract for $2, that means you're selling it for $200. Here's the first scenario we want to discuss. You own a stock at $44. You're going to sell a 3-week out option expiry, the $45 call, for $1. Now, someone exercises their right to buy the stock. Let's talk about that. First off, here's the note I was talking to you about, the fact that you've entered into an open agreement now. That sold contract is an open order. It means somebody has the right to buy it from you. Now, you can buy that call option contract back, hopefully at a lower price to offset what you sold it for and pocket the difference. But I've underlined here, someone exercises their right to buy. In that situation, here's what you're going to realize. You end up selling the stock for a $1 gain. You owned it at 44, put it up for sale at 45, got paid $1 when somebody bought it for 45. So that's 100 shares times $1 profit, $100 in your pocket. You also keep the $100 for selling the $45 call. That's the one contract equivalent to 100 shares times the $1 premium, that's $100. So you take the $100 from each situation, and that totals $200. So $200 is a 4.5% return on investment. That's $200 on that $4,400 purchase. So again, the stock at $44 times 100 shares, $4,400. $200 on that is a 4.5% return for a 3-week experience. Scenario number 2, you own a stock at 44, sell a 3-week out option expiration, the $45 call for the $1, and no one exercises their right to buy the stock. So again, the sold contract's in open order until it's closed by either you buying it back to close, someone exercises their right, or in this case, as I have underlined here, expiration comes and goes. You can basically rip up that contract. It's null and void. It no longer exists. It's expired. and you get to keep that premium. Let's talk about that real quick here. You do not sell the stock, hence no money to be made because there was no sale that happened. You keep the $100 for selling the $45 call. That $100 is a 2.27 return on investment, again, for 3 weeks. Now, if you're able to do this each month, and that's, of course, you're able to keep the stock and do this, or you're doing this on other stocks, but that 2.27 each month for 12 months is not a bad little 27% return on this scenario with this strategy, the covered call. Now, we're not breaking the bank, but you are cha-ching ringing that cash register each month. And that's, again, if you want to do this each month. You can do shorter term expiries, you can do weeklies, you can do leaps, okay? But let's just say you're doing it for 3 to 4 weeks. So ring that cash register, bring in that $100. Now, if you found a $100 bill laying on the sidewalk outside of your house each month, you're likely to pick it up. Or are you just going to leave it out there for the neighbor kids? I mean, that $100 bills isn't going to break the bank for you, but that's $100 you can put towards your favorite charity each month, okay? So as long as you own the stock, as long as you own a stock in 100 share increments, you have this strategy available to you every month if you like. You have the opportunity now to get paid every month, whether you sell your stock or not. You have the opportunity to bring in some revenue. Now, how do you find stocks to do covered calls in Tom's Tools? There's our website, www.tomsoptiontools.com. Ideally, we're looking for stocks in a sideways or range-bound pattern, a sideways channel. So if you're looking at growth stocks that are just going to ramp up higher, maybe you don't do this strategy because the likelihood of getting called out is very high. But if the stock trades within a range, trades kind of sideways, you have an opportunity to generate this monthly income because the stock's not going to run away from you and get called out or bought. So log into the tools, hover over the stocks tab, hover over the stock rankers line item, left click on channel finder. You'll go to the page with this box at the top, and it even has a help file. When you get to this page, which is the channel finder page, that help file will tell you all about these line items. These wizards are what we know as scans. So you can look up the wizard criteria, the scan criteria, by clicking on the show hyperlink, tweak it to all you like, or leave it as a default. Say, I'm going to use the S&P 500 optionable list. You can use whatever list is in there or custom create your own. But we want to then select best sideways channel. I would also maybe look at best sideways channel and up, meaning a slightly upward sloping channel. Then we're going to leave it 21 to 45 days because that best represents a month. We're looking to generate monthly income. Let's leave it at that number of days and then click on search. This is the search output page that you'll get when you run that search, and you'll see the number of stocks. You'll see all these different column headings for these different stocks listed below, and you can read the help file and pick up what all of these different column headings mean and signify to you with these numbers. You'll see that in the stock column, it says chart and pick. If you were to click on the chart hyperlink, you get a candlestick chart representation of that stock. If you left click on pick, you're going to get a candlestick representation of that chart, plus some channels being highlighted and put into view for you. So here you can see a sloping upward Cisco, but in the more recent trend, it's going pretty much sideways, as emphasized right there visually. So on this Cisco, let's say you bought or you own 100 shares and you bought those shares at $46. You then see that there's an August 21st $47 call that you can sell for $1.59 or $159 for that one contract. There's just another representation of the chart and the risk graph showing you the max profitability at expiration. It's the dollar that you can gain on the stock plus the $159 premium that you sold for $259. That coincides down here with about that profit target. So there's what you can sell that August 21st 47 call for, $159. So here's the money situation. If you're called out on Cisco, you bought the stock for 46, you sell it for 47. That's $1 per share profit. So 100 shares times that $1 per share is $100. You also keep the $159 for selling the August 21st $47 call. So $100 and that $159 makes $259 in your pocket now. That $259 is a 5.4% return for this 4-week experience. Now, what happens if you get called out? You can either take your money and do whatever you want with it, or you can put it back into more trades, more investments, whatever you like. You can also check to see if you still want to own the stock again and check its current price, check the next month out calls, see if it's worthwhile to do again or put that money into a different trade. Now, here's a situation if you're not called out. There's no money to be made from the sale of the stock because no stock was sold. So you keep the premium though. You sold the August 21st, $47 call for $1.59 times the one contract, which is the equivalent of 100 shares. You make the $159. $159 is a 3.45% return on investment. Now 100 shares times the 46 stock price is $4,600. You make $159 against that $4,600. Again, a 3.45% return. Not bad for a little 4-week experience where you own the stock anyhow, but now just for putting it up for sale, you bring in an extra $159. And again, you're going to keep that whether you sell the stock or not. But here's a caution. Do not use this strategy if you don't want to sell your stock because it could get called out. It could get called away from you. Somebody has a right to buy it from you. If you don't want to sell this stock, don't do the covered call strategy. If you inherited this stock and your ancestors would roll over in their grave if they knew you were selling it, maybe this is one strategy that you don't use with that stock that you own. If you don't mind selling it, or you go ahead and you buy stock with the sole intent purpose of doing the covered call strategy, then the covered call strategy is for you. Here's a couple of variations on the theme as I'll wrap. If you bought the stock at 22, you see this established support here. Here's an established resistance area at 25. If you picked it up at 22 and you want to write the $25 call, wait for it to run up to 25 because the $25 call option will get a higher price as it's closer to the $25 resistance. So a $25 call when it's trading around 25 is going to be more expensive than if that $25 call or what that $25 call is when it's down around 22 support. So you own the stock, wait for it to roll up to 25, sell the 25 call. If it rolls over, here's where you can start looking at buying back that call to close it. You still own it at 22, it ramps back up to 25 again. Hey, guess what? Write another $25 call at that point in time. That's just one consideration. Wait for the stock to get closer to the strike price that you wish to sell. That way you get a higher premium for the sale. A couple of other things here. Buy a longer term call option instead of the stock. A leap options is a consideration. You can even buy 3 months out option expiration, buy a call for 3 months out and sell the front month or the next month out call against that. So instead of owning the stock and paying the higher price for the stock, you can use that leap or longer term option as a proxy for the stock. And then last, how about selling a put first? If your account can sell puts, you're cash secured, meaning if you sell one put, which is the right for the markets to put you to stock at a certain price. If you're cash secured, meaning if you get assigned the stock, your account has the money to purchase that, guess what? You're getting paid to now purchase the stock. That's a premium that you're taking in for selling the put. Now you get put to stock, you own the stock, guess what you can do? Covered calls. Now you start generating more premiums on the stock that you owned that you were paid to own in the first place by selling the put. So we can bring you more videos in the future here. We can talk about a calendar or time spread, which is that longer term option is a proxy for the stock and sell shorter term call options against that. And then there's also the selling puts strategy. But folks, again, we'll save those videos and those topics for another day. This one was getting paid whether you sell the stock or not, the covered call strategy. Hope you've enjoyed that. We'll see you on future videos. Thanks. Bye for now.